The Indian securities market, under SEBI's regulatory purview, began its journey in 1988. However, the roots of Indian securities market can be traced back to the beginning of 18th century, making it the oldest in Asia. Dharohar, an initiative by SEBI, is an endeavor to capture the evolution of our nation's securities market. Dharohar has three distinct offerings that allows users to step into the evolution of India's securities market. Interactive timeline, immersive galleries, and informative website. With interactive timeline, uncover the milestones with seamless navigation features, from pivotal events to iconic personalities, and from various markets to their regulations. In its second key offering, Dharohar brings you 8 distinct virtual galleries like share certificates, mutual funds, commodity markets, debt, equity markets, and personalities. The experience doesn't end here. Lastly, the website is a unifying platform for all visual and textual information available across Dharohar. Here, one can dive into a wealth of knowledge like never before. Watch interviews of eminent personalities that have shaped the Indian securities market. Understand complex market concepts through engaging informative videos. Explore key moments of India's financial history with newspaper clippings and share certificates. This is Dharohar, a bridge between legacy and progress. Preserving history, safeguarding the present, educating generations, inspiring the future, and continuing to grow and evolve with time.
So that was a video on SEBI's virtual museum, Dharohar, Milestones in the Indian Securities Market. It is a comprehensive digital repository documenting the evolution of the Indian securities market through historical archives, newspapers, clippings, interviews with eminent personalities. Participants are encouraged to visit the museum for further learning at mism.org. Link will be pasted in the chat box for your reference. So, hello and good evening, everyone. I am Mansi Khanekar from the Investor Education Department of NISM. NISM is the capacity building initiative of SEBI. We at NISM conduct a wide range of activities at various levels with the objective of improving quality standards in the securities markets. At NISM, we work in 5 broad areas: long and short term academic programs, certifications for market intermediaries, e learning programs, training programs for working professionals and academia, and various investor education initiatives. Today's webinar topic is Finfluencers, Friends, and WhatsApp Tips: How to Protect Your Money in the Age of Financial Noise by Sanjeev Govila, a former Indian Army officer with 27 years of distinguished service. He is an alumnus of the National Defense Academy and the Indian Military Academy. After opting for voluntary retirement, despite being approved for the rank of brigadier, he founded Hum Fauji initiatives dedicated to the financial well-being of Indian Armed Forces personnel and their families. He has conducted over 350 financial literacy workshops for the armed forces and is a widely published financial expert and regular contributor to leading business publications and television platforms. Now I would request Sir to begin with the session.
Thank you very much, Mansi, for my introduction and for giving me this chance to be here. I would just 1 minute. Yeah. Okay. So can I start my presentation straight away without wasting any time?
Yes, sir. You can
Yeah.
share your screen as well.
Okay, I'll share my screen. Just a minute. There is one problem though with sharing my screen. Somehow it's not going in the
IT team, can you?
no,
Yes.
there is no problem at
Yes,
all.
done.
We can definitely, go ahead with this itself. Right. Just 1 minute. Can you see my screen?
Yes, sir. It is visible now.
It is visible now. Okay,
Yes.
great. So just let me give me a minute.
Sure, sir.
I will just share my screen again. Some problem is taking place.
Okay, sir. So for the time being, participants can see we have pasted the link of the SEBI's virtual museum on the chat box. So you can access it.
Sir, I think we can continue. Let it be as earlier. ठीक है sir?
Okay. So
Yes.
is the screen shared? Not shared?
Not shared, sir. Not yet.
Yeah. Yeah, we tried it just now. I don't know what's happening.
Yes.
Some problem is taking place and I'm not getting to see the screen sharing kind of thing. Can you share the screen?
Yes, I
Hello?
will share. Yes,
Yeah,
yes.
I think that
Yes.
will be better because some
Sure.
problem is taking place.
Yes.
Because of which
Give me a
we,
minute. I will
yeah,
just share in a minute. In
we
a
just
minute.
tried it. It was working.
No worries, no worries, no worries. So you just keep me on telling that when to change the slide.
Yeah,
Okay.
that I know.
So yes, now I'm sharing my screen so that it can be visible to all. Yes, it is visible, sir, to you. It's visible, right?
It's visible?
Yes, yes.
Okay, yeah, I can also see it. So
Yes, yes.
friends, uh, I'll just, hmm. So as you all can see, the first slide that is there and it very, very loudly says that financial noise is very, very loud. So good afternoon, everybody. I thank NISM for organizing this investor education webinar on a subject that has become extremely important for today's investor. And that is precisely why you all are here. We're not going to discuss one stock, one fund, one product, or one market prediction. Those questions may look urgent at times, sometimes too many times, but for most investors, they are not actually the real issue. The real issue today is this: how does a common investor protect his or her judgment when financial opinions are almost everywhere? Earlier investors suffered because information was not easily available. Today, the problem is totally different. Information is available in excess. Every morning, there is a view. Every evening, there is a prediction. And every market movement has 10 explanations. You all will agree with that? So the challenge today is not only financial literacy, the challenge is financial filtering. Because if we cannot filter what we hear, we cannot protect what we ourselves own. My objective today is very simple. Before acting on any tip, reel, video, message, or advice, you should be able to pause and ask, is this meant for me? And do I truly understand what I am about to do? That one pause can save years of regret. Next slide. Just read the heading. The new investor is not uninformed. He's over-influenced. What does it mean? Let us begin with the new Indian investor today. India actually never had such wide participation in the securities market. NSE data itself shows that by April 2026, the regular investor base had crossed 13 crore unique investors with about 25.7 crore client codes. This is a very positive development, shows that we are going the way the world is already. More Indians are using demat accounts, SIPs, investment apps, and market-linked products. But every good change also brings a new risk. The same mobile phone that gives an investor access to markets also gives the market access to the investor's mind. Earlier, investors moved very slowly. Today, a message can arrive on your mobile phone at 9:15 a.m., create excitement by 9:20 a.m., and can actually become a trade by 9:30 a.m. That is the speed we are facing today. That speed is convenient, but it can also be very dangerous. The new investor is not uninformed. He may actually be watching much more financial content than any earlier generation, but he's also over-influenced by notifications, influencers, friends, relatives, WhatsApp groups, Telegram channels, and most importantly, profit screenshots. We all will agree with that. So the real question is no longer, do investors have information? The real question is, do investors have the judgment to decide which information deserves attention and which deserves deletion? Next slide. Next slide.
So it's already done.
Yeah. Okay.
Yes.
Right. I'm getting a small screenshot. No? Yeah, I'll make it bigger. Okay. So as I've written, awareness has risen. Judgment has not kept pace. And awareness and judgment are not the same thing. We all know that. SEBI's Investor Survey 2025 gives us an very important insight. It says 63% of households are aware of at least one security market product, but only 9.5% actually participate in securities market. It also says only 36% investors have high or moderate market knowledge. That leaves out 64% who don't have market knowledge at all. This tells us something very important. Many people have heard of mutual funds, stocks, demat accounts, SIPs, IPOs, ETFs, and futures and options, FNO. But hearing about something is not definitely the same as understanding it. A person may know that equity can create long-term wealth, but does he understand volatility? A person may know that FNO, futures and option, exists. But does he understand leverage, odds, capital requirement, and most importantly, emotional discipline? This gap between awareness and judgment is where the actual mistakes happen. Sometimes people know enough to become confident, but not enough to become wise. That is a dangerous stage. Because when partial knowledge meets easy execution, investors can act very fast and regret at leisure very slowly. So our purpose is not awareness, it is better judgment. Next slide. A free tip can become very expensive. Almost every investor has heard these lines written on the slide. Buy this stock. This fund is a rocket. Guaranteed strategy. My friend doubled his money. Don't miss this opportunity. Big movement coming. The tip is free. The loss, if it comes, is yours. Remember that. Advice can be casual, but the consequences are always personal. The person giving the tip may forget it by the evening that he or she gave a tip. You may carry its impact for years. Remember this important line. The person who says buy may never tell you when to sell. The person forwarding a message may not even know the original source. The person who made money may not tell you how much risk he took, how many mistakes he did, or whether he simply got lucky. I'm not saying every tip is wrong. Some ideas may be useful, and some friends may genuinely be trying to help you. But the investor's responsibility is to examine who's saying this, why are they saying it, what can go wrong, is it suitable for me? Or if this goes wrong, who will bear the loss? Every tip must pass through your own thinking before it receives your money. Remember this. Next slide. Before your money moves, your mind is moved. What is the meaning of this? We usually think that an investment decision begins when we click buy, sell, redeem, or subscribe. To tell you very frankly, actually the decision begins much earlier. First comes attention. A headline, a thumbnail, a chart, a message or profit screenshot catches your eye. Then comes emotion, excitement, fear, curiosity, envy, regret, or the feeling that you may miss out, FOMO, fear of missing out. Once that is there, then comes the confidence. You begin to feel, oh, this makes sense. Maybe I should also do it. Maybe I should not delay. Maybe delay may cost me a lot. Then and only after this comes action. So the transaction, remember, is always only the last step. The real damage or the real discipline begins much earlier in mind. That is why financial noise is so powerful. It first attacks attention, emotion, urgency, and your confidence. Suppose the market falls and your phone fills up with messages saying, crash has started, exit now. Your goal and time horizon may not have changed, but your mind changes. And once the mind changes, under pressure, the portfolio follows. Portfolio changes. Remember, this portfolio is changing under pressure and not because anything wrong is actually with the portfolio. Next. So we come to the 4 loudspeakers of financial noise. Let us identify these 4 major loudspeakers of financial noise which are there on the slide. The very first one is Finfluencers, that is financial influencers. Some are genuine educators, I agree, but some are entertainers, promoters, or unregistered advisors dressed as educators. Second, friends and family. This is powerful in India because we trust familiar voices, a colleague, a neighbor, a cousin, a relative, or a friend who made money last year. Third, WhatsApp and Telegram groups. These platforms make messages feel personal. They're coming on your own mobile and urgent. A forwarded tip often feels more believable than a formal warning. Fourth is market headlines and social media trends. Budget, election, war as is going on right now, interest rates, IPO frenzy, gold rally, small cap rally. All these have happened recently. They are continuing to happen. Every event becomes an instant investment opinion. The problem is not that these sources exist. The problem is that they can enter the investor's life without any suitability filter. A serious investor must separate information, education, opinion, and advice. Information says this happened. Education says this is how it works. Opinion says this is what I think, and the advice says you should do this. The real trouble begins when opinion is treated as advice and confidence is mistaken for competence. So somebody giving you very confident advice, we think he is competent, may or may not be. Next. So Finfluencer, are they educators, entertainers, or advisors? Let us talk about Finfluencers, financial influencers, with fairness. It is easy to say that all financial influencers are bad. I do not believe that. Many people online do real useful work. They explain concepts, they simplify jargon, and they bring financial topics into everyday conversation, into our life literally. That is good. But investors must understand what they are consuming. Is it education? Is it entertainment? Is it opinion? Is it marketing? Is it a hidden recommendation? Or is it advice without accountability? The last one is important. There is a difference between explaining what an index fund is and saying, buy this fund now. There is a difference between teaching asset allocation and creating excitement around a stock, a sector, or a strategy, or even a theme. SEBI also recognize this area is important enough for regulatory attention. So you see SEBI's regulations coming all the time, and they'll continue to come as and when they discover what are the novel ways that bad advice is being given around. So the answer is not to reject all online content. That is neither practical and nor actually necessary. But remember this, social media rewards attention, not responsibility. Responsible advice is often boring. Viral content is often exciting. And in investing, boring is usually profitable, while exciting stuff can actually be expensive. After watching any financial content, ask yourself, am I wiser or only a bit more excited? That may do the trick to your wealth and to your portfolio. Next. This is a very common thing. a friend's profit. Let us come to a very Indian source of investment decisions, friends and the family. Most of the time, it is well intentioned, no doubt about it. No friend, no family member would like to harm you in all probability. A friend says, I invested in this fund, it has done very well. A relative shares a stock. A colleague talks about a particular theme or sector. Someone says, why are you keeping your money in boring investments? See what others are earning. Starts getting you. This is how many investment decisions begin. But a friend's profit is not your financial plan. Remember that. Your friend may have different income, different risk appetite, very important, different time horizon. He may be investing for very long term, you may not be, and different responsibilities. What can he risk? How much money can he risk, which you cannot, or vice versa? He may have entered at a different price and may exit before you. He may not need this money for a child's education next year, which you may need. He may have made money because of luck, not skill. Who knows? Good news travels fast. Losses travel quietly. So people don't come to know who's made what loss, but what profit, the whole world knows. And that is the one that gets everybody's goat. People discuss profits with confidence and mistakes with silence. Nobody agrees that they have had a loss. So if you build your portfolio from other people's success stories, you may be seeing only half the truth. Listen politely, but bring the decision back to your own life. Borrowing an idea is very easy. Borrowing someone else's risk profiles, risk capacity is almost impossible. Next slide. Urgency. That is how people play with others. WhatsApp and Telegram have changed the speed of financial influence. A message comes in the morning, buy before 10 a.m. Target in 10 days. Reliable source, operator movement is going to take place in this stock. Big news is expected. I received one yesterday also. Forwarded by someone who knows. These are the kind of messages that come. These messages are designed around urgency. And urgency is often the trap. When a message forces speed, remember, it weakens judgment. It makes you feel that if you do not act now, the opportunity will disappear forever. SEBI issued a public caution in April 2025 against fraudulent and manipulative activities on social media platforms related to securities markets. That warning really matters to all of us, because fraud rarely introduces itself as fraud. It comes actually dressed as opportunity, and that is where it gets us. It uses words like exclusive, premium, insider information, assured returns. Target is this. It's a multi-bagger returner. Operators are already into it. Guaranteed return and last chance, act. A sensible investor should treat urgent financial messages with great suspicion. If an investment idea cannot survive one night of thinking, it probably should not receive your money. Pause, verify, check the source, ask what can go wrong, ask why there is pressure to act immediately. In investing, a disciplined delay is not weakness, it is self-defense. Remember this. Next slide. The market rewards patience, noise rewards speed. This is a very important contrast. The market always rewards patience. You must have heard from so many people. And the noise will always reward speed, as I'm saying, and I'll explain why I'm saying that. Good investing usually needs time. Businesses need time to grow. Mutual fund portfolios need time to deliver. Asset allocation needs time to work. Compounding needs time to become visible. But digital noise wants reaction right now. Click now, watch now, buy now, sell now, join now, don't miss now. That is what digital noise is all about. Social media is designed for engagement. Markets are full of uncertainty. Wealth creation is built only and only through patience. Right? Once Warren Buffett was asked by Jeff Bezos, why isn't everybody rich, wealthy like you? Warren Buffett simply replied, because nobody wants to become rich slow. Says it all. When these three things, that is markets, wealth creation, social media, meet, investors can become really confused. A patient investor starts feeling lazy. I'm not acting, I'm doing nothing, I'm just sitting. A disciplined investor starts feeling being left behind. A long-term investor starts feeling foolish because someone online is showing faster, and even faster profits. But remember, speed is not intelligence. A person changing investments every few days may only be restless. A person reacting to every single headline may only be more disturbed. More lasting wealth is built through a few good decisions, repeated with discipline, and protected from unnecessary interference. That's how lasting wealth comes in. The ability to sit quietly when others are shouting is a serious investment skill. Remember this. Next slide. Why intelligent people still fall for bad advice? People who fall for bad advice, bad financial advice, are not necessarily foolish. Many are educated, successful, and careful in other areas of their career, their life, their everything else. They may be doctors, engineers, business owners, officers, professionals, or very successful executives. So why do intelligent people still fall for bad advice? Because investment is not only maths, it is largely emotions. Greed says, others are making money. Fear says, I will miss out. Envy says, why not me? Overconfidence says, I can exit before others. And the regret says, oh, I missed the last rally. These emotions are not signs of weakness. They're part of being human. We have to recognize that. And once we recognize that, solution begins. But the problem begins when emotions become instructions. A mature investor does not become emotionless. That is impossible. Nobody can be emotionless, especially when your hard-earned money is involved. A mature investor builds a system so that emotions do not control decisions. That is why written rules, asset allocation, time horizon, position sizing, review discipline, risk profiling, and second opinions always matter. At the moment of excitement or panic, intelligence alone may not protect you. A system protects you when emotion is louder than wisdom. Please remember. Next slide. Suppose we take it that whatever financial influencers are saying, whatever other people are saying, whatever our WhatsApp broadcasts are saying, whatever our channels, Telegram channels are saying, everyone is making money who's following them, then why is the regulator worried? Let us look at one hard piece of data. SEBI's September 2024 study on equity derivatives found that 93% of individual traders incurred losses in equity, futures and options between financial year 22 and 24, 2 years data. Aggregate losses exceeded 1.8 lakh crores over 3 years, right? Please pause and think about those 93%. They're not a small warning. They're not a few careless people losing money. This is a deep behavioral problem. And yet outside, FNO, futures and options, is often shown as exciting. Quick income, smart trading, daily profit, weekly profit, one setup and one strategy. That is how it is projected. Screenshots are shared. Courses are sold. Groups are formed. People are told if they learn one single method, they can make money consistently. This does not mean no one can trade profitably. Some can, definitely. But the real question is, what skill, capital, discipline, risk control, and emotional strength does it require? Most common investors do not ask this question to themselves. They see as excitement, they don't see odds. They see profit screenshots, not aggregate losses. They see confidence, they don't see risk. Noise can make a difficult game look very easy. The first rule of wealth creation is not to maximize return. I'll just repeat it. The first rule of wealth creation is not to maximize return. The first rule is to avoid avoidable damage. Next slide. Trading is not investing with more excitement. Let us clarify these three words: investing, trading, and speculation. Investing is ownership. You are owning a business. You participate in an asset because you believe it can create value over time. Time and underlying value work in your favor. Trading is timing. You are trying to benefit from short-term price movement. It requires speed, discipline, risk management, position sizing, and emotional control. Speculation is a bet. It may be informed speculation, or it may simply be hope wearing the clothes of confidence. Hope wearing the clothes of confidence. All three are totally different games. The problem begins when a person enters one game but calls it another. A stock bought for quick movement suddenly becomes investment. An FNO tip from a Telegram group becomes strategy. Financial strategy, long-term strategy. A bad trade becomes long-term conviction because one cannot sell in losses. A person refuses to exit a loss and calls it patience. This confusion could be very, very expensive. There's nothing wrong with learning markets deeply or taking some risk with knowledge and discipline. But the common investor must be honest to himself and herself. Am I trading? Am I investing? Or am I speculating? Honesty about the game is the beginning of investor protection. Honesty about the game that you are actually playing is the beginning of your investor protection. Next. The real question is not, is this true? Then what is the real question? This particular slide may be the most practical idea of today that you can take with yourself. Most investors ask, is this tip true? The better question to ask is, even if it is true, is it suitable for me? That is a better question. A good idea can still be wrong for you. A good stock can be wrong if the amount is too large. A good equity fund can be wrong if the money is needed after 1 year. A good small cap opportunity can be wrong if you cannot tolerate a sharp fall. A good investment can be wrong if it creates tax problems, liquidity problems, emotional stress, or has no connection with any of your goals, financial goals, future financial goals. This is why suitability is more important than excitement. Suppose someone says equity creates long-term wealth. Broadly, that may be true. But should a person invest next year's school fees in equity today? Obviously not. Suppose someone says this particular fund is number one. Even if it is, does it fit your risk profile, asset allocation, holding period, and existing portfolio? May or may not. Financial advice without suitability is incomplete advice. So shift the question from the product to yourself. Is this good for me, for this amount, for this purpose, for this time horizon, and with this risk that I will have to take? Next slide. Again, another important slide, the 7-question filter. Let us convert today's discussion into a practical tool for you to apply. Before acting on any tip, reel, video, message, advice, something coming on your mobile, ask 7 clear questions, not to them, but to yourself. First, who's giving this advice? Is the person qualified, experienced, registered where required, or simply confident online? Because there is anonymity online. Second, is the person accountable? If things go wrong, is there any responsibility? Third question, what is the risk, not just the return? If someone talks only about upside, the conversation is really incomplete. Fourth, why is this suitable for me? If the person does not know your goals, your time horizon, liquidity needs, risk capacity, how can the advice be specific to you? Fifth, how much can I afford to lose? Very clear. Sixth, what is my exit plan? If something goes wrong, will your short-term investment, you will start calling it long-term investment just because you don't want to exit, because you cannot exit in losses? Think about it. And the last one, am I acting from reason or simply from emotion? These questions will not make you perfect, but they will slow you down. And in a noisy financial world, slowing down is often the first step towards becoming wiser. The investor who has a filter may still make mistakes. We all make mistakes, but these mistakes are less likely to be impulsive, excessive, or damaging. Next slide. So, after talking about all this, what does good financial advice actually look like? Now that we know what bad influence looks like, what should good advice, what kind of clothes does it come in? Good advice does not begin with a product. It begins with your life. What are you investing for? Retirement, children's education or their marriage, home purchase, emergency security, financial independence. Then comes the time horizon. Money needed after 1 year cannot be treated like money needed after 15 years. Very clear. After that comes risk capacity. Not just willingness to take less risk, but ability to absorb losses without damaging your or your family's life. And then comes there are things like liquidity, tax, family context, and your spouse's and your family's behavior. Do you panic in market falls? Do you change recent performers? Do you hold too many funds? Do you sell winners too early and hold losers for too long? Only after this should the product enter the decision, not before this. A product is just like a vehicle. Before choosing the vehicle, you must know the destination, the road, the passenger, the budget, and your own driving ability. The product first advice may give a quick answer, immediate answer, but it may actually be answering a wrong question. Next slide. Collection of exciting ideas is not what your portfolio should be. Many investors, rather most of the investors, do not actually have a portfolio. They have collections, lots of things collected on their computer folders or physical files. A little equity fund from one year, a sector fund from another, a stock bought on a friend's or Finfluencers advice, gold after a rally, a tax saving product bought in March, insurance sold as investment, a few IPOs, some bank FDs, corporate FDs, some small cap exposure. This is just a collection. This is not a portfolio. Each investment has its own story, but together, actually, they may not form any kind of a plan. A portfolio is different. A portfolio gives roles to each investment. Emergency money protects you. Debt gives your money a stability. Equity creates long-term growth, maybe with volatility, but long-term growth. Gold may provide diversification. Insurance protects the family. Gold-based investment funds, they fund known responsibilities. Every product must earn its own place in your life, in your portfolio. So the question is not, is this product good? The real question you should always ask is, what role will it play in my financial life, in my family's financial life? Noise keeps adding ideas. Wisdom keeps creating structure. A crowded portfolio, like I told you about, is not necessarily diversified. Sometimes it may just only be confused. So step back and ask, do I see a plan or do I see a collection with me? Next slide. So what should be your personal protection system against all this financial noise that we've talked about so far? Let us build a simple personal protection system. First, pause before acting. Very important. Second, verify the source. What is the source? Where is it coming from? Why is it coming? What is the underlying reason that it is coming? Third, check the registration where advice or recommendation is being given. Right? What is the authenticity of that person or that company giving this advice? Registration, of course, does not guarantee protection, but absence of registration should actually make you very cautious. Fourth one we talked about quite a lot is avoid urgency. Words like guaranteed, sure shot, last chance, operator movement taking place, or double your money should make you slower, not faster. And fifth is write down the reason. Before investing, write one sentence. I am investing in this because, fill in your reason. If you cannot write a sensible reason, do not invest. And sixth is limit your position size. Even if you want to experiment, keep the amount small enough that a mistake does not damage your financial future. And the seventh one is review with a competent person. A second opinion is not weakness, it is seriousness. This system is not dramatic, what I've told you. It will not go viral, but it can protect your money, which is the most important thing that matters to you. In a noisy world, your personal process is your shield. Adopt it. Next slide. Your first asset is your judgment. Let me close the main thought of today. In investing, your first asset is not your salary. It is not your savings. It is not your mutual fund. It is not your demat account. It is not even your portfolio. The first asset is your judgment. Money follows judgment. Bad judgment can destroy even high income. You must have seen it. I've seen it so many times. Good judgment can protect and grow even a very modest saving. The next time a Finfluencer, friend, relative, headline, WhatsApp message, or Telegram group asks you to act immediately, remember this. Your first job is not to find the next opportunity. Your first job is to protect your judgment. Ask who's saying this? Why are they saying it? Are they accountable? What is the risk? Is it suitable? And am I acting from reason or simply emotions? These questions look very simple, but they are really powerful. Because in investing, one avoided mistake can be as valuable as two good investments. The investor who does well is not the one who bears the most, who hears the most. It is the one who filters the most. So, next slide. So, what is the real defense against financial noise? What have we really covered today? First, the problem. The modern investor is not short of information. He is overwhelmed by influence and pressured into hurried decision. Second, the noise. Finfluencers, familiar noises, WhatsApp ecosystem, and non-stop market commentary are increasingly shaping investor behavior. The third one is vulnerability. Vulnerability. Greed, fear, false confidence, speculative temptation, and poor suitability assessment can make even sensible investors act unwisely. And fourth, the protection, sound filters, better questions, responsible advice, portfolio structure, and disciplined judgment are the real safeguards. So the core message is very, very simple. Do not outsource your judgment. Use information, learn from educators, real educators, listen to experienced people, read widely, take professional help where needed. But finally, every decision must fit your life, your goals, your risk, your time horizon, and your peace of mind. Financial noise will only increase. The investor who succeeds is not the one who hears the most. It is the one who filters the most. Thank you. I'll be happy to take your questions now.
So there are few questions in Q&A. I think we can take that.
Yeah, actually,
Questions.
like I told you, that there is some problem with my, I'll
Okay.
still try. It is somehow not coming on.
So should I
Yeah. I'll have to depend on you actually.
Okay, no worries, sir. I will
While in the
do that.
meantime, I'm still trying to figure out as to what's gone wrong. Yeah.
Okay, so anonymous attendee is asking that
Hmm.
what practical framework do you personally use to get financial advice from this noise before making your investment decisions?
Personal, this thing, the very personal first thing that I did was to get education, right? That is the most important thing. Uh, Education and not acting with speed, right? This, yeah, I just one second. Let me, yeah, I can see that questions now. Ah,
Yes.
ah. What practical framework do you personally use to get financial advice from this noise before making your investment decision? Actually, probably you've already answered the question yourself. Why should you look at financial advice from this noise? Most of the time, you really cannot make out what is the source. Something coming on WhatsApp, some friend is telling you, I got this kind of a tip from somewhere. You can't make out what is the source. If the source is not known, take my word, reject it. If you don't take a seemingly profitable proposition coming to you, seemingly is the word that I'm using, it will not matter to you at all. It will not matter to your life at all. Go slow. Do not jump in at anything that is coming to you. It will not work. All these TV channels who are telling you to buy this today, buy that today. Suppose you got one of those subscriptions, let's say Economic Times app and all that. They are giving you 10 tips a day. Can you buy them? You don't know why they are giving it. If you don't know why they are giving it, you should not act even on a single one of them. The best thing that you can do is, okay, take your time. This tip is coming to me. Let me ask somebody who knows better, or let me do my own research. When you do your own research, either conviction will come or you'll delete that tip. That may be much better for your money, for your life, for your family, rather than acting on something in haste and regretting at leisure. The next question, where can I may no, this is not the question. Presentation, I think it'll anyway be uploaded on the NISM website.
Sir, we do not provide direct presentation, but we do provide them recording of this session, so they can make their own notes or they can go through the recording of this session if
Okay,
they want
okay.
presentation. Yes.
So there was a question on that. Then there is a question from Stephen. Delay in investment, is it good? Noise is always there. Absolutely. Noise is always there. I fully agree with you. But if suppose there is some investment about which you are convinced, which you have gone through, which you have researched, which you have consulted somebody who may know better than you, who acts as your second opinion financial doctor, and now you are convinced that it is good, then there may be no need to delay. But I'll tell you a better way to act. Whenever you want to take an investment, don't take investment for the sake of an investment. Please get a financial plan made. What is a financial plan? What are your requirements in life? Suppose you have a requirement coming up 5 years later. Let's say your son or your daughter or somebody is going in for education. You yourself are going in for education. What is the kind of investment that will suit that time horizon? You want to buy a car next year. The first investment, that is 5 years later, and the second investment, which is required for 1 year later job, they may be totally different. So that is how you decide. In my presentation, I've tried to bring out that investment is the last step. Investment is not the first step. If you make investment the first step, somewhere your judgment will leave you. What is the purpose of money in life? The purpose of money in life is to be there in right quantity at the right time when you need it. So we are talking about long-term kind of a thing. Where is the need to act today on something you heard today, or the need to act tomorrow? when you're going to do investment for your lifetime, going to make the best use of the money. That is precisely what I have tried to bring out in my presentation. Okay, somebody is asking me why SEBI not banned Finfluencers, etc., or a change process of social media verification, etc. See, I definitely am not knowledgeable enough to answer this question, but I've definitely seen in my 16 years that I've been a financial advisor, I've seen a huge change in how SEBI is acting. They have brought in huge number of changes. They have penalized a large number of social media influencers, but they are in thousands and lakhs and millions. How can one organization do that? So somewhere they have tried to do a lot of it, and I'm really appreciative of SEBI the way it is working. But obviously, there are so many of them all the time, and it is a question of judgment who is giving right advice and who's not. From where we should learn about stock when we get buy recommendations from friends. Do a lot of research. There are so many research platforms available. It may not be artificial intelligence, it may not be AI, could be authentic sources are available. There are so many of them available online. I will not name anyone because that's not my business to name that. But there are big names who will tell you what is a stock like, what has it done, or you can even Google and go into that stock's details, current details. How is the company performing? What are the past details? Depending on whether you are more leaning towards technical analysis or fundamental analysis. Actual investment should be a combination of both of them. Fundamental analysis tells you whether this stock is worth it or not. Technical analysis tells you when to invest and when to sell. So there are plenty of such information available. What about SEBI registered Finfluencers? There is no such thing as SEBI registered Finfluencers. There are SEBI registered advisors. If a SEBI registered advisor becomes a financial finfluencer, there is a strict code of conduct they have to follow. And if they don't follow, they will be penalized heavily and their license would be cancelled. So I would not call them finfluencers because somehow the word finfluencers right now is treated as negative. Somebody anonymous is asking me, you have been advising many investors. Yes, we are handling about more than 4,000 investors today. Whom do you go for advice? Oh, the whole advisory world is there to give me advice. We financial advisors have lots of support systems. We financial advisors have lots of groups where real good things are being talked about. After 16 years also, I can say maybe I know about 15% of what is financial advice. So it is very frequently we lean upon each other for finding out what is good, bad, and ugly, and giving advice whenever we are in doubt ourselves. Analysis paralysis can happen, agreed, but I'm not talking about that world where you've done everything and you want 100% correctness before you go into a decision. That in no facet of life is correct, but you should come to a reasonable point. I think I have done enough analysis. Now it is good to go. Otherwise, definitely what you are saying, Dilip, I fully agree with you that analysis paralysis can happen. There are another one, Pushkaresh. There are newborn creators who are creating educational financial literacy content. So how can we trust them? As content creation is the future of earning, so they also want to enter into creation as financial influencers. So what should they do? See, nowhere in my presentation I have said that financial influencers are not good creatures. Nothing like that. There are so many people who are doing such a human service to the investor community by giving absolutely free, frank and valuable advice. So I'm nowhere saying that financial influencers are bad. I'm just saying that those kind of things which are bad for you should not be gone ahead with, and you should have the judgment to realize which financial influencer is a good person to listen to and which one is not. Nobody will tell you that. You have to use your own judgment for that, and then discuss with others who are in your groups and all what most of the financial influencers who mean good for you, in all probability they will not give you a stock advice. So if there is a stock or there is a particular mutual fund advice which is coming to you free, then deal with it with caution. Research and study, fully agreed.
Hello, sir.
Yes, sir.
Sorry to interrupt. I think this can be our last question as we are running out of time. Is already
Okay.
five,
Okay.
6
So
actually.
I'll see which is the one that I
Sure.
can.
Yes, which
And
you find important, you can address that, and then I think we can conclude the
I think
sessions.
I'll take this because,
Sure.
Bhavesh Mehta has asked from where to find professional planners for genuine investments. I would say look for a RIA, registered investment advisor. A registered investment advisor is a fee-based advisor. He doesn't get any commission, nothing from anywhere at all. He or she will only get fee from you. The fee will continue from you only when you are getting good advice. So they are absolutely for you, working for you, not working for anybody else. Look for a registered investment advisor. Where do you find registered investment advisor? You will find them on SEBI's website. There are two types of registered investment advisors. One is individual in registered investment advisor, that is RIAs, and there are registered companies which are called corporate RIAs. You can look at them and go for the RIAs only. I'm very sure, and because I'm very, very closely integrated with the RIA community, I'm very sure you'll find one RIA who means good for you, suits your temperament, and will make your financial goals be fructified in times to come. So that's it. I've been told to close now. Thank you very much for everybody for attending this. And I'm confident that you would have gained something from this webinar. Please apply it in your life. That will be the best appreciation you can give to me. Thank you very much.
Thank you so much, sir, for the time and value which you have shared throughout this presentation. I mean, it was very helpful to all the attendees, and also thank you to all the participants who has joined today's webinar. So before leaving, I wanted to tell everyone about the NISM's initiative, that is reel making contest. So I'm going to play a short reel which will help you understand that how it will work, sir. Okay.
NISM Reel Making Contest 2026 is back. Lights, camera, finance. Financial literacy isn't just about money, it's about making better life decisions. One story can help millions. Understand finance better. Use your creativity to simplify. Saving, investing, budgeting. Smart financial decisions. Create, inspire, educate. Bring your ideas alive through short films, skates, creative reels, role plays. Make financial literacy engaging, relatable, memorable. Get creative and create slogans, suggested themes, smart investing, regulators, investor-friendly initiatives, fraud and scam awareness, safe investing practices, financial literacy for everyone. Reel guidelines, 50 to 120 seconds, any language. English subtitles recommended. No plagiarism. Respectful content only. Who can participate? Students, creators, young professionals. Anyone passionate about financial literacy. Win exciting cash prizes. First prize 50,000 rupees. Second prize 35,000 rupees. Third prize 25,000 rupees. 10 consolation prizes, 5,000 rupees each. Your story, your creativity, your impact. Submit and inspire. Financial empowerment. Hashtag NISM Real Contest.
So yes, that was the video about NISM reel making contest. Also, I'm sharing one URL of NISM reel making contest. So by visiting that, you will be able to understand how to participate in it. So yes, it's done. It's pasted in chat box, so you all can visit that link for more information. So now I request